Welcome to Smart Wealth with Joshua.
Your daily stock analysis and catalysts talk. Today we're looking at Intel.
If you find our talks useful, please consider subscribe, like, and comment underneath, because today we are looking at a story that, honestly, it kind of feels like a massive whiplash moment for the market.
Oh, absolutely. I mean, if you've been following the tech sector over the past, 10 or 15 years, you probably have a very specific idea about this company locked in your head.
Right, the old narrative, the idea that they were just like this total relic.
Exactly. The prevailing wisdom was that they dominated the 90s, but then they totally missed the smartphone revolution, and they were actively getting left behind by the whole AI wave. I mean, financial analysts were literally calling it a lost decade.
Yeah, a value trap.
Yeah.
But looking at the data for our analysis today, I mean, that narrative is completely dead. We're looking at a historic fundamental inflection here.
It really is. And to understand the scale of it, we have to start with the hard numbers from the first quarter of 2026. This wasn't just some subtle earnings beat that people can brush off.
No, it was a blowout. I mean, total revenue hit $13.6 billion.
Right, which is a 7% year-over-year increase.
Yeah.
And, the Wall Street consensus was sitting way down around $12.4 billion.
So they cleared the top line by like 10%, which for a mega cap company is just massive.
Totally massive. But honestly, the total number isn't even the craziest part. It's the composition of that revenue. The standout segment, like by a mile, was data center and AI.
Yeah, that's the metric everyone's waiting for. And it surged 22% year over year, right? It hit $5.1 billion.
Exactly. And you have to remember, in late 2025, that exact same segment was only growing at like 9%.
Wow. So it rapidly accelerated.
Very rapidly. And it's highly profitable growth, too. Operating income for that segment multiplied by 2.7 times to reach $1.54 billion.
That's just wild. And at the same time, their legacy business, like the standard PC chips, stayed really stable at $7.7 billion.
Right. The client computing group held strong.
While the foundry side, the actual manufacturing business, grew 16% to $5.4 billion. But I actually want to pause on the profitability metrics for a second, because the gross margins in this Q1 report are staggering.
Yeah, the margins are where you really see the turnaround mechanics working.
Mhm.
They posted a non-GAAP gross margin of 41%.
And I want to break down what that actually means on the factory floor for the listeners, because just a few months before this, in mid-2025, that margin was sitting at a trough of like 33.7%.
Right.
And in semiconductor manufacturing, you don't just, jump from 33 to 41% by cutting a few corporate expenses. That's not how it works.
No, not at all. Gross margin reflects the direct physical cost of manufacturing.
Exactly. So an increase that sharp means their manufacturing yields, like the percentage of perfectly working chips coming off a silicon wafer, must be improving dramatically. Yep. They're throwing way fewer defective chips in the trash.
Spot on. Better yields mean less waste. It means you aren't wasting time on those multi-hundred-million-dollar lithography machines. And that operational discipline flowed straight to the bottom line.
Yeah, adjusted earnings per share hit 29 cents, right?
Yep. And Wall Street was expecting a paltry 1 to 2 cents. They completely obliterated the estimate.
Obliterated them. And the Q2 forward guidance shows this isn't just a fluke. They're projecting $13.8 to $14.8 billion in revenue, with EPS at 20 cents, easily beating the old estimates of 7 to 9 cents.
Which brings up the most, perplexing question for anyone reading tech headlines lately. How does a legacy hardware company post 22% growth in an AI market that is completely dominated by GPUs?
Right, because the whole narrative has been AI requires GPUs, end of story.
Well, the initial AI boom was entirely about training massive foundational models.
Right.
And training is basically a brute force math exercise. You're feeding trillions of parameters into a system, which requires parallel processing.
Doing thousands of calculations all at once.
Exactly. And GPUs are explicitly designed for that. But what our data highlights is a massive technological shift happening now in 2026. The industry is moving from pure training to real-world inference. Specifically, this concept of agentic AI.
Okay, let's unpack agentic AI, because this seems to be the first major pillar of their totally new competitive moat.
So think about traditional AI. You ask a chatbot a question, it spits out a single response. Agentic AI is totally different. These are systems that execute multi-step complex workflows autonomously.
Like doing actual tasks on their own.
Right. Say you ask an agentic system to research a competitor. It might deploy one AI model to scrape the web, another one to analyze financial spreadsheets, and a third one to write the final report.
Okay, so it's a bunch of models working together.
Exactly. Intel's chief revenue officer, Greg Ernst, noted that this architecture requires hundreds of smaller, specialized models communicating with each other simultaneously.
Oh, wow. So if we look at the hardware for that, the GPUs might still be generating the text or the images, but the CPUs, the central processing units, are basically acting as the orchestra conductors.
That is the perfect analogy.
They're managing the memory, tracking the logic steps, and just making sure these hundreds of AI agents don't crash into each other.
Yes, CPUs are built for complex, sequential logic. Because agentic models need constant coordination between different software apps, the demand for CPUs has gone, through the roof, as Ernst put it.
So the whole industry absolutely requires robust CPUs to manage this complex AI stack, which basically insulates them from the GPU-centric competitors.
Precisely. They're dominating the orchestration layer. The GPUs fundamentally rely on them to function in an agentic environment.
That is a fascinating pivot. But as powerful as that CPU layer is, the second pillar of their new moat might be even more critical, especially on a geopolitical scale, and that's sovereign manufacturing.
Yeah, this is the structural advantage that separates them from almost everyone else in tech. They operate the only leading-edge foundry in the Western Hemisphere.
And when we say foundry, for the listeners, we're talking about the physical fabrication plants, the clean rooms, the extreme ultraviolet lithography machines, printing circuits on silicon wafers.
Right, the actual manufacturing. Because for decades, the tech industry went entirely fabless. Companies like Apple or Nvidia designed the chips, but outsourced the actual printing to Taiwan.
Almost entirely to Taiwan, which is obviously a huge vulnerability.
A massive concern. There is this enormous government-driven push right now for sovereign AI. The U.S. government and its allies are aggressively trying to de-risk the supply chain from geopolitical flashpoints in Asia.
So because they own and operate these foundries on Western soil, they are the main beneficiary of this whole shift in global policy.
Exactly. They're positioned perfectly.
But logically, building a leading-edge foundry is astronomically expensive. Tens of billions of dollars just for one facility. How are they paying for all this infrastructure without just going completely bankrupt?
Well, that capital intensity is exactly what analysts have been worried about for years. But if you look at their Q1 balance sheet, they have fortified their war chest to a level we've never seen. They're currently holding $17.3 billion in cash and equivalents,
Okay.
plus $15.5 billion in short-term investments and $8.5 billion in equity.
So that's what, over $41 billion in total liquidity?
Yeah. And they are deploying it with supreme confidence.
Oh.
For example, they just paid $14.2 billion in cash to buy back Apollo Management's 49% minority stake in their Fab 34 foundry in Ireland.
I really want to look at the mechanics of that Apollo deal because it sends a huge signal. When a private equity giant like Apollo buys a stake in your factory, they're giving you upfront cash for a share of future profits. So buying out that stake for $14 billion, that's basically the corporate equivalent of paying off a high-interest mortgage because you know your income is about to skyrocket.
That's exactly it.
You only do that if you are absolutely convinced the factory is going to generate massive free cash flow and you want to own 100% of that upside.
That is the exact read on the situation. Now, to be fair and keep a balanced view, we do have to note that their free cash flow margin over the trailing 12 months is negative 5.8% right now.
Okay, so they are burning cash.
Yes, but that negative flow is entirely driven by the heavy capital expenditures to stand up their next-gen nodes, specifically the 18A and 14A processes.
Let's clarify what 18A and 14A actually mean since, semiconductor jargon can get super dense. The A stands for angstrom, which is even smaller than a nanometer. We're talking atomic-level transistor design.
Right, the angstrom era. The physical limits of silicon mean you can't just keep shrinking transistors without running into massive heat issues. So 18A and 14A are entirely new architectures for stacking components and delivering power.
So it's incredibly expensive R&D.
Very expensive. But the operating leverage in Q1 suggests that once these nodes reach scale, the path back to positive free cash flow is incredibly clear.
And they aren't shouldering this burden alone, right? There's been a wave of external backing. The U.S. government stepped in with a near 10% stake worth $8.9 billion through the CHIPS Act.
Yep. And SoftBank took a 2% stake for $2 billion.
And then there's the one that really made waves. Nvidia bought $5 billion in newly issued shares. Now, I have to push back here. Nvidia is the undisputed king of AI hardware right now. Why on earth would they hand $5 billion to a competitor?
It looks crazy on the surface, but it's actually a brilliant strategic hedge by Nvidia. Their entire multi-trillion-dollar valuation relies on getting their designs manufactured right.
Right.
And right now, they are heavily dependent on Asian foundries. By dropping $5 billion into the leading Western foundry, Nvidia is essentially paying to ensure a robust backup supply chain exists.
Oh, wow. So they're basically funding the construction of their own emergency parachute.
Exactly. And the market is heavily speculating that this investment is laying the groundwork for a huge future contract, where Nvidia actually uses these new Angstrom-era foundries to print their next-gen GPUs.
So you combine the U.S. government, SoftBank, and Nvidia, and that totally de-risks the capital needed to finish these facilities.
It fundamentally de-risks the whole roadmap.
Given all that backing, the violent reaction we've seen in the stock market starts to make a lot of sense. Let's dig into the technical breakout. After the Q1 earnings, shares surged, 23 to 24% in a single day?
Yeah, on massive volume.
Yeah.
And you essentially saw a combination of two things. First, a huge short squeeze.
Right.
Investors who bet against the stock for years suddenly faced massive losses, so they had to buy shares at market price to close their positions, driving the price even higher.
And second,
Massive institutional reallocation. Mutual funds and pensions that had written the stock off as dead money realized they were super underweight on a company central to the AI boom.
the stock hit record highs, right? Between $82 and $87, that's up over 300% in the last year. I mean, if you look at the 2025 lows when it was under 18 bucks, that's a 220% recovery.
It is a definitive breakout, and underlying all this price action is a severe supply and demand imbalance. They simply cannot manufacture chips fast enough. UBS analyst Timothy Arcuri noted their capacity was roughly 10% below current demand.
And their chief technology officer, Dave Zinsner, hinted the backlog is in the billions, right?
Exactly. Which perfectly frames the massive customer validation they just got. Elon Musk formed a consortium with Tesla, SpaceX, and xAI, and selected this foundry for a $25 billion terafab project in Texas.
A $25 billion project. That is insane.
It's a watershed moment. Analyst Patrick Moorhead frames this exact scenario as the main goal of the CHES Act. The whole point was to get private tech giants to commit capital to domestic manufacturing. Having Musk's entities commit $25 billion proves the sovereign manufacturing thesis isn't just theory anymore.
It's actually happening. So if you're listening to this from a wealth building perspective, trying to map out the next 2 quarters, what are the specific catalysts we need to watch?
3 critical events over the next 3 months. First, Q2 earnings in late July. The market will be hyper-focused on whether they hit that upgraded $13.8 to $14.8 billion revenue target, and if those margins keep expanding.
Okay, that's
Second is the release of the 14A process design kit, version 0.9.
Wait, let me make sure I have the mechanics of a PDK right. A process design kit is essentially a massive software sandbox, right? It gives external developers the digital blueprints for the physical factory.
That's highly accurate, yes.
So if I want to design a chip to be manufactured on the 14A node, I need the PDK to know the physical constraints, the power rules, the spacing of the machines.
Yes, so releasing version 0.9 means the 14A tech is mature enough that massive customers, like the Tesla Terafab project, can seriously start designing their next-gen silicon for these facilities. It's a major milestone.
Got it. And the third catalyst?
It's macro-oriented. Watch for any regulatory movement on a potential SHINKES Act 2.0. If the U.S. government authorizes another massive injection of non-dilutive capital, it would further accelerate the foundry timeline.
The momentum is undeniably compelling. But, when a stock runs up 300% in a year, we have an obligation to step back and look at the bear case, because these valuation multiples are, frankly, pretty extreme.
The valuation is absolutely the biggest risk factor for new capital right now. Following the rally, the forward price-to-earnings ratio is floating between 70x and 161x, depending on which forward estimates you use.
Whoa, 161x, just to put that in perspective. A forward PE of 160 means you were paying $160 today for $1 projected earnings over the next year. That's the highest multiple on their history, right?
Quite far.
It totally eclipses the dot-com bubble peak, which was like 55x. And while the data center segment is booming, the foundry segment is still bleeding cash. They posted a $2.4 billion operating loss in Q1 alone after losing $10.3 billion in 2025.
Right.
So with a multiple that sky high, isn't absolute perfection already priced in? Like, if the yields on the 14A node disappoint even slightly, won't this stock just completely collapse?
The risk of multiple compression is very real. When a stock is priced for perfection, any misstep is punished. If there's a delay in the 18A or 14A nodes, and in this industry a persistent yield issue can easily delay a rollout by 6 to 12 months, investors will rapidly reevaluate the stock.
You could see the multiple compress from 160x down to 40x without the actual revenue even shrinking.
Exactly, resulting in a violent sell-off. Plus, if macroeconomic demand for AI cools down generally, capital will just rotate out of semiconductors entirely.
It's the classic danger of a parabolic trend. You're betting that execution remains flawless in one of the most physically demanding engineering environments on the planet.
You are. However, the counterargument to that execution risk brings us right back to the liquidity. Yes, the foundry is bleeding billions today, but with over $41 billion in total liquidity, plus government and Nvidia backing, they have the financial runway to absorb those losses.
They can afford to troubleshoot the yields.
Right, they can bridge the gap until the foundry reaches economies of scale and projected profitability in 2027.
So, synthesizing all this data, the blowout Q1 earnings, the pivot to agentic AI, the massive sovereign manufacturing tailwinds weighed against the extreme valuation and execution risks. What is the final consensus here?
The aggregated data points to a bullish score of 8 out of 10, but the critical variable is your time horizon. The consensus clearly states this is not a short-term swing trade. It is strictly a multi-year hold.
You have to be willing to stomach the volatility.
Exactly. Over the next 18 months, you have to ride it out to capture the full ramp-up of the 14A node and that ultimate path to profitability in 2027.
To summarize the core thesis we've unpacked today, they are aggressively pivoting from a legacy hardware model into the foundational orchestration layer of the agentic AI era.
Right.
They've built a highly defensible dual moat by dominating the CPU requirements for multi-agent inference while operating the only leading-edge foundry in the Western world. And they're doing it with multi-billion-dollar backing from the U.S. government, Nvidia, and Elon Musk.
The Q1 numbers just validate that the turnaround isn't just a PowerPoint presentation, it's happening on the factory floor ahead of schedule. The customer wins fundamentally de-risk a roadmap that analysts totally doubted just 12 months ago.
Which actually brings up a final structural question to leave you all with. We spent time today analyzing PE multiples, margins, and operating losses, basically evaluating this entirely through the lens of a traditional publicly traded tech company.
Right.
But if they successfully build out these Angstrom-era foundries and become the indispensable physical manufacturing hub for the U.S. military-industrial complex while powering private giants like Tesla and Nvidia, do we have to rethink the entire paradigm?
That's a great point.
Does it eventually cease to be evaluated as just a volatile tech stock, susceptible to normal market cycles, and start being valued as critical state-backed national infrastructure? And if that shift occurs, what does that do to the stock's long-term floor? It's a fascinating paradigm shift to mull over as you watch the price action unfold.